All right, y'all, welcome to another video. Today we are going to be going over liquidity. This will be the first episode in my trading lessons playlist for you guys, so I can teach you a little bit more about the markets and I guess just the fundamentals that go into my strategy. So starting off, we're going to keep it really simple but complex in a way, and we're going to start off with liquidity. So here's a table of contents, what we're going to be going over today. What is liquidity, why it matters, the types of liquidity, where is it found, and the common mistakes. And after the slideshow, I'll go over some examples. Okay, so what is liquidity? Liquidity is where unfilled buy or sell orders are resting in the market. And every buyer needs a seller, and every seller needs a buyer. So price will seek to distribute and fill these orders, essentially. Every buyer needs a seller, so if there's a buy stop, if there's a sell stop, there will be a buyer for that price if price hits it, and same for the opposite. Large institutions use these unfilled orders to move price. So if you're thinking of an institution that trades, let's just say, like millions of contracts at a time, right? That amount of contracts will move the market drastically compared to, let's just say, if I trade like 2 contracts of NQ per trade. So with these large institutions having the ability to move the market in such a drastic regard, they're looking for these liquidity pools where a bunch of buy and sell stops are resting so that they can fill all their orders at once and move price. If there's not enough liquidity at a certain if there's not enough liquidity at a certain price, then the market will move to seek out more orders. So if there's not enough liquidity for a large institution to fill their massive order of, let's just say, their massive limit orders, then they're going to wait until more liquidity generates so that they can fill that order. Essentially, this is why we have a accumulation, manipulation, and distribution leg. The accumulation leg occurs when there's not enough buy and sell stops for these institutions to fill their orders. It manipulates down, and we get our distribution leg once they fill their orders. So why does liquidity matter? Well, in trading, once you understand how liquidity moves markets, it increases your odds of catching large moves drastically. And as a trader, you're going to want to capitalize on these moves as best as you can and as often as you can. And understanding how the markets move through liquidity sweeps, fair value gaps, inverses, all that, which I will get into in the next upcoming videos, is very important. But right now we're going to keep it nice and simple. This is the baseline to my strategy. And it matters so that you can avoid fake outs. Fake outs occur within the market constantly. And if you understand how the markets move and liquidity works, then you're going to avoid these fake outs a lot more. Risk management. So risk management might be let's just say it's one of the most important things in trading. If you're not risking the proper amount, if you're over leveraging, over trading, right? And you're trading on bad liquidity moves, and you don't know how to manage your position size accordingly, you're going to go extremely in depth. You're going to be losing so many trades if you can't get that aspect down. And if you learn more about liquidity, right, you can adjust your position size accordingly. If you have a very probable liquidity sweep paired with other confluences, then you can risk heavier on those trades that are more A+ compared to a trade that maybe be like a B+ trade. So yeah. Okay, so there are 4 main types of liquidity that I'll be going over in this video. The first 2 are buy side and sell side liquidity. So buy side liquidity is when resting buy stops above swing highs and previous day highs, data highs, session highs occur. So that is buy side liquidity. Sell side liquidity is the opposite, where it's resting sell stops below swing lows or at swing lows, right? So buy stops, sell stops. Buy side liquidity, sell side liquidity. It's pretty simple. And then we also have internal liquidity and external liquidity. Now I'm going to make a separate video for this because It's very important to understand this, but essentially, internal liquidity are imbalances of price within a range, such as fair value gaps and opening gaps. So basically, price will rebalance into these levels after sweeping an external liquidity, which I'll go over next. But it's important to understand how imbalances work and how it moves price. I'll get into that a little bit later. But for now, let's just focus on internal and external liquidity. So external liquidity is probably the most common thing you think of when you think of liquidity sweeps. It's just major structural highs and lows. So price will seek out to take these areas since they consist of the most resting orders. Where is liquidity found? Okay, so there's definitely more places where liquidity is found just because it's all over the place, but these are the main ones that I like to focus on for my strategy. So session highs and lows, I like to target Asia, New York, and London session swing highs and lows because they move independently from each other and they create very nice places for liquidity to form, therefore making the draw towards that liquidity very profitable and very profitable. Previous day highs and lows, not much to be said. It's just great places for the market to target. Essentially, these swing highs and lows will be the most prominent for price to target. Fair value gaps, so I kind of touched on this a little bit, but they represent imbalances in price where orders are filled way too quickly and it's very inefficient. And this leaves a lot of buy and sell stops within that fair value gap left over since price can't fill the entire thing. Well, it can fill the entire thing, but most times there will be some some stops there, which is why price often rebalances into those gaps. Opening gaps, so NWOGs, new week opening gaps, and NDOGs, new day opening gaps. It's kind of the same thing, a little different. Imbalances in price where the market opens at a different price from which it closed. So if you think of NWOGs, right? Once market closes on Friday, it'll be at a certain price. And when the market opens on Monday, let's just say there's like some sort of news event that happening, price can open up all the way up here, or it can open up all the way over there, it could open up at the same. Generally, it will be opening at a different price, so that's a very good liquidity point for you to target. Data highs, data lows, pretty simple. It's just swing highs and lows formed by news. Very good points to target. Equal highs and lows. This one is very important because equal highs and lows, you can use it as a very good confluence or a very good negative confluence to not enter a trade. Essentially, equal highs and lows and just increases the amount of buy and sell orders within a liquidity pool. Just think of like, let's just say there's two equal highs. Basically, you're just doubling the amount of buy stops within that range. So yeah. Okay, so here are some common mistakes of trading with liquidity. Obviously, if you're trading in choppy conditions, you're going to be trading within the accumulation period, which I said is where majority of buy and sell stops accumulate essentially, and that's where these large institutions want price to move around so that they can generate the liquidity needed for them to eventually fill their orders to distribute higher or lower. So yeah, if you get caught up in that range, you're kind of cooked. So you just got to know when that is happening and how to fade it if it's happening. Another common mistake is ignoring the higher time frame narrative. Not every imbalance or draw will be swept and delivered from, and you really just need to see the bigger picture, right? If you're focused on the 1 minute time frame, and the 1 minute time frame is screaming shorts, well, let's just say right now we're at all-time highs. So if you look on the weekly time frame, it's just straight up. Why would you short that, right? Even if you get like, let's just say a liquidity sweep at a prominent high on the 1 minute, you got to zoom out to the weekly. The weekly is screaming bullish. You don't want to be shorting. That's just one example. Trading without a clear direction. So having no clear target within your trading, it will destroy your win rate. It will destroy your win rate. You need a valid target every time you're taking a trade. And if you don't have that target, then I promise you, you will lose. Okay, so that is it for this slideshow. Let's get into some examples. Okay, I have nothing marked out, I have nothing planned. I'm just gonna show you guys what I see in the market. So already starting off, I see a liquidity sweep right here, right? We're in a slight downtrend over here. And then we form this low right here and we sweep it out and price ends up heading higher. Now, it is not this simple. Let me make this clear. It is not this simple in the markets. You have to pair this with other things like a imbalance, a fair value gap, which I believe we have right here, over here on the higher time frame. You need to pair liquidity sweeps with fair value gaps and inverses, which I believe we have right over here. But still, this is just kind of getting you guys to see how liquidity sweeps work and fair value gaps. There's a fair value gap that price taps into here after taking out external high over here. Price then seeks to rebalance into this fair value gap formed over here before eventually going higher. Now, this is just one example. Obviously, as I said, it is much more complex than that, but it's just getting you guys to see what I see in the market. Right here is a very nice NWOG that price will probably end up rebalancing into after this uptrend is done. Let's see what else we can find here. Okay, see right here is a very nice accumulation. You don't really want to get caught up in this chop. Unfortunately, we don't have a sweep right here, so no trades would have been taken. But yeah, that is what accumulation looks like. Here's a very nice example of manipulation and distribution. So as you can see right over here, we have pretty much an accumulation leg off this. We eventually sweep out these lows resting over here and over here, and we get a nice inverse off this candle right here to eventually head higher. You can capitalize off of that. Let's see what else we have. Same thing over here. Liquidity sweep off this candle right here, and we head lower. Remember to pair that with the higher time frame. Okay, this is another form of accumulation. You don't want to get caught up in that. This accumulation normally forms like aftermarket when the volume dies down and there's not a clear direction. Here's an example of an NWOG being filled, right? We formed this NWOG right over here from Friday to Sunday, and we actually have a liquidity sweep off this low. We tap back into this fair value gap right over here, and we head higher a little bit to fill this inefficiency right over here. So that is a great example of just comparing all the things that I kind of went over just now. Another liquidity sweep. What else? Another inverse over here. We'll go over inverses in the next video. Let me find a good example of, I'm sure this is also a fair value gap on the higher time frame too. So just pairing everything together as I've been saying. And like I said, not all NWOGs are going to be filled. So this one is a prime example of one that doesn't get filled until, well, actually it just doesn't get filled. So that's a prime example of that. You need to be pairing all your confluences together for taking a trade. You can't just take a trade just because there's an NWOG, you know what I mean? You need structure. Let's see what else. This is a very nice distribution leg right here. Here's a very nice liquidity sweep. Bang. Let me find a very good example for you guys that's just crystal clear. Another NWOG that gets filled over here. Okay, this is a pretty good example. I don't know if there's a higher time frame gap, but if you look right here, if I can draw straight, boom, liquidity sweep, and we get a nice inverse off this candle right over here, and we head lower. You could have taken something like this maybe and targeted like a low down here, as well as we have very nice low resting liquidity. We'll go over that in another video, but as you can see, we sweep out this swing high, sweep out buy side liquidity, and head lower. Okay, I'll go over one example, then I'll probably end this video. You guys can always ask questions in the comments if you have any about this concept, but okay, this is a very nice one. I like this. So right here, as you can see, we have a very large NWOG, right around 300 points. Let's just say 250 points. Price taps into this inefficiency, which is a fair value gap to the left. I'm sure it's definitely on a higher time frame, but let's just mark it out as this for now. And the ultimate target is going to be this NWOG close of the previous week. Now, what actually happens is once we tap into this inefficiency to the left, this fair value gap right here, we get a nice rally higher. But we then sweep out more liquidity. Right here, we get a nice liquidity sweep of this low, and we actually inverse this fair value gap right here. Bang. What you could have done in this situation is you could have entered right here, stops at this low, and target this high right here, and bang. Well, I guess in this case you would have gotten edged by like 1 point, but if you do what I do, which is I put my take profit maybe like a couple points below, this would have hit. And yeah, this is just kind of how the market moves, right? We got a sweep of liquidity, and we are rebalancing from a swing low and this fair value gap, and we just push up higher. So yeah, hope you guys learned something from this video. Leave any comments, any questions below. As I said before, keep following the Instagram, join the Discord, it's free. I trade live pretty much almost every day. So if you want to trade with me and learn my strategy a little bit better for free, that's an option. But I really appreciate you guys for tuning in. It means a lot to me to help educate you guys on what I like to do. But yeah, I'll see you guys in the next one. Peace.